How's it going, everybody? I'm the BTC Reaper. My goal on this channel is to teach you how to reap the rewards of trading whether the price is going up or down. The simple versus exponential moving averages. We use the exponential moving averages, we don't use the simple moving average. I will explain why at the end of this video. I trade a little differently than this article explains, so stay tuned for that. Moving average is smooth price data from a trend following technical indicator. They do not predict price direction, they show it with a lag. So they're not going to show you if price is going to go up or down, it's going to show you if price is going up or down. As the name might imply, there's a simple moving average that's very simple and basic. For stocks, it's calculated by adding all the closing prices for a specific number of time periods, then you divide that by a total number of periods. For example, if you want the 10-day SMA, you add the closing days for the last 10 days, then divide by 10, which each day moving forward will replace your first day for that 10-day period. Exponential moving averages are a little bit different. The exponential moving average is more sophisticated than the SMA. The calculation starts out the same, but it's modified so the recent data points in the series have more weight than the older ones. Because of this, it can be a little bit different of a support resistance, and we will show the differences. For example, in a 10-day EMA, the most recent data would count as 18.2% of the total, but the first would only count as 3%. So here's the calculation if you're interested. An interesting quirk of the EMA is that about 87% of the data that is used to calculate it. The rest is all history that's taken from a long period of time, but for practical purposes, it's irrelevant. But when to use these? With moving averages, the longer the time period, the slower it will react to the movement. But everything else being equal, the EMA will track price more closely than an SMA. Because of this, the EMA is considered more appropriate if you're doing short-term trading. The EMA will move with price sooner than the SMA, so it can get whipsawed and make your entries a little bit murky. We will show an example of that on the charts here. So our orange line on this chart is our EMA. Our blue line here is our SMA. So if you look back here, our EMA attempted to break and push lower. That could have signaled that we would have had a downtrend, because when you get that on your SMAs, you typically will see breakdowns. Here it doesn't highlight this breakdown didn't play out, but either way, not guaranteed. You'll want to watch your other indicators. No indicator is 100% on its own. So if you're using just these EMAs or SMAs for your entry, you should be using the money flow we're going to talk about shortly too. But when you are above these bands, you typically come back down to them. When you're below these bands, you typically come back up to them. So that is how we typically look at them. Like on this EMA here, we would have told you that at some point it would end up likely coming back because price was breaking up, and we have been extended for quite some time. Most likely this gap would have filled at some point. You would see how price acted. We rolled away, we created a gap here, created a gap here. We did fill these two first gaps with this drop. We continued down, tried to break our EMA. That could have signaled we would continue lower if you got confirmation. That's why confirmation is important, and you don't just jump in. Right here, there is no confirmation. We don't have a red candle after this red candle. If we had a red candle after this red candle that was strong like this red candle here, then that could have brought us down. But when you don't get confirmation, you may not see things play out. That's why we say, look for confirmation and rejection, watch your money flow, watch how the asset's doing. Now back here, you can see inverse. We broke above, we did not hold above. We tried to get confirmation, but that was an indecision candle telling you that we could have reversed at that point. There was a gap to the upside, so likely that could come up to fill, but that's a whole different discussion. Now, when you are below these EMAs, you would typically say that you would bounce up at some point. You have this big run down. You could have waited till this run down played out, saw this run up, saw this other break down, and you could have known, since you did not fill this gap here and here, that you would have run up to fill the gap. So that could have been a little indication there. That's why you want to use more than one thing when you're trading. Don't just go at one indicator. That's why we cover so many indicators, because they all work in tandem. you for watching today's video.